That was a good choice of song there, man. I love your playlist every time we run a webinar.
Thank you. Dear. Alrighty. Well, we will still. We're not going to kick off with the webinar straight away because usually it takes a couple of minutes for everyone to join in. We've got 30 people connected so far, but I do want to share a couple of things before we get into it. The first one is we run regular webinars here at Inspire, and we've already got our next one booked in. I think this is next Friday. I think it's literally the end of next week, where we're going to be talking with Joanna Oakey, the founder of Aspect Legal, all around the legal considerations with acquiring a business. I am going to share some stuff on due diligence and also what to have a look in with the numbers behind things, but the main focus is all about the legal side of things and how you de-risk your purchase there. So if you haven't already, then feel free to book in for that one. Rose from our team has actually just popped the link to register for that one in the chat box if you do want to join that one. Very cool. Now, the other thing you might see on your screen is also a, well, I'm going to pause that. We're not counting down again, is a poll. And so what the poll is asking is, what are you here to learn about? So obviously the topic we're going to chat through is all about the federal budget, which was released at 7:30 p.m. last night. It's been a big, almost 24 hours for our accounting team, just trying to get what this means for us. But yeah, what Riz and I would love to know is who's joining us, what are you interested to learn about, and yeah, like if we haven't got an option there, please just pop a thing in the chat box. And I think Mohammed's asked which areas will be affected in view of investment. So I didn't have investors as an option there, kind of intentionally, but I'll explain why soon. Even though the the context of this webinar did mention investment. Anyway, what we will do is, cool. So I might just do a brief introduction to myself and Riz. So my name is Ben Walker. I started Inspire quite a few years ago, I think in 2013, and it's been an interesting journey since, but fun. Really love what we do. We're in a pretty cool mission at the moment. So we've got a massive goal of saving tax. So we're up to $13 million for our clients so far, with the goal to save 2.1 million in kind of the time we're in right now, April, May, and June this year, which is tax planning. Cool news is we've just ticked over, I think, about 1.2 or 1.3 million dollars yesterday. So we're more than halfway along our goal there, and I think we're going to smash it out of the park. So that's pretty cool. And also want to introduce Riz, who is my co-presenter today. So Riz is the general manager and chartered accountant here at Inspire. And Riz joined in 2016 after being an in-house accountant for a number of large businesses around Brisbane. And with an impressive tax savings. So this is last year's goal. You got $3.3 million on your own.
And yeah, and that, just for context, that's throughout the year. And yeah, we're looking for more in this kind of mini sprint that we have between April and June. Super busy time. Yeah, I changed my shirt this time from the last webinar that I had from that photo. So good to see that I have different shirts.
Yeah. That's it. Dear. So what we're going to cover on the webinar today, and Riz and I are going to sort of bounce off each other and cover a topic each, like we normally do on these sort of style of webinars. But we're going to cover what's in the budget for small business, what's in the budget for SMSFs, and in doing so in those two things, there's a couple of broader updates, more around families or individuals that we might cover, just simple stuff. Also, the other interesting thing around investors, and I can see in the chat box, we've got a couple of comments on retirees and investors, but not in related to super, and then another comment on, yeah, what's going to happen with investors. At the end of the day, not a lot. In fact, I can't really see anything that directly impacts investors from, let's say, a tax rate change, or if you invest in a certain class of asset, then you get a better concession. So there was actually zero from a pure investment lens, but there was a bit in there was a fair bit to do with super, and also small businesses and families. So I guess we can cover more specific questions around investment if you've got them, but the news is that there's actually no news for investors. Like, let's say franking credits was a hot topic in previous budgets. There's no changes. That's a good thing from a franking credit perspective, but yeah, no changes there. Also, I can see a few clients with us today, which is really cool. There are quite a few of you who might not yet be working with us, and I think there's a few accountants on the call as well, which is quite interesting. But I just want to invite you, if you're not yet working with us and you're just keen to explore what it might be like doing that, then we can offer you a strategy call, and Rose is about to pop the link in the chat box if you do want to go and book something in. But whether it's to have a bit more of a chat about your situation on the budget, or learn more about our tax planning season that we're in, you might want to be a part of that Save Tax campaign. But anyway, you can use that link to book in for a strategy call with one of our accounting team and get some questions answered and suss us out. But moving through, one more thing to keep in mind as well. So the budget was released last night, and the budget isn't like final until it's passed through legislation. So I do want to keep in mind that most of the stuff that's talked about in budgets does eventually pass through, but do keep in mind that it is in a way subject to change, and there's plenty of fine print. So we're kind of sharing some high level stuff, and for each topic we'll have sort of 4 or 5 key points. But if you are in doubt or you do want that guidance, then please always make sure you get advice on your personal circumstances. It would be quite frustrating if you did something that wasn't actually quite as intended. So yeah, there you go. Alrighty, well, Riz, I might get you to kick off with our first change, and I'll hold the slide for a sec. But this is one of the things that doesn't quite fall under the category of small business on its own. It's not super, it's not investment, but it does apply to pretty much everyone. So what I would love you to do is run us through the Limito.
I love the fact that you pronounce Limito. So Limito stands for low to middle income tax offset. Now, you might have heard of this last year. It was supposed to end at 30th of June in a month or so. So essentially, that if you earn you're a low to middle income earner, you can get a maximum of $1,080 of a tax offset. Now, tax offsets are super powerful. It's unlike the depreciation, immediate depreciation rules and all this other stuff. A tax offset is literally a discount on the tax bill that you get. So if you usually pay $1,000 in tax, you wouldn't pay tax at all in this situation. So it really takes it off the bill straight away. So it is quite powerful, and they've extended that beyond this financial year, which is great. Now, obviously, it also applies to the couple, and if you can see the math there, it's just the double amount of the singles, which is 1,080 times 2, and yeah, the income that you earn is between $48,000 and $90,000. This is great news for everyone, because that's literally cash back in your pocket when you do your tax returns. Now, it applies to everyone who earns income and pays tax in that threshold, obviously, and you get that full amount of tax offset straight away.
And I guess here's one of the ones that actually applies to investors indirectly, where if you're invested in property or shares or investments in your own name, or you receive income from a trust that runs investments, then this is one of the ways that might flow on to you. So yeah, I guess there is indirect investment stuff as well.
Yeah, it is pretty amazing. And in terms of the cash refund of that, I believe it's a non-refundable tax offset. So what happens is it offsets whatever tax you do pay. So you're not going to get extra cash into it. So there was a bit of confusion when they released this last time. Everyone's knocking on the ATO's door. Where's my $1,000 I was supposed to get? If you didn't pay tax last year, you wouldn't get this as a cash refund. It's just an offset on the tax that you pay already. But if you prepaid tax, you will get that as a refund.
Cool. There you go. Awesome. Thank you. Thank you, Riz.
That's okay.
Now, what I'm going to do is actually share another one that also isn't small business specific or SMSF specific, but it does actually apply to quite a number of our clients. And that's all about the childcare rebate. And the category I've popped here is families, which you might have seen on the poll that we did earlier. So this is quite interesting because, if you earn as a couple or as a household over $189,000 combined, and you know that is relatively easy to do when you've got a profitable business and you might be distributing, 100 grand each. You're already over that limit. But when you did that, the childcare rebate applies a threshold of just over 10 grand per child. The good news is that cap per child is actually now removed. And I'll mention the date in a sec. But if you've got 2 or more children in care, then you also get a 95% rebate on your childcare, which is massive compared to what you would have ordinarily got, which is 65. So that's an incredible move. And I thought we wouldn't normally talk about this stuff in the lens of business and SMSF, but I do think it's going to be relevant for at least a quarter of our clients, which is cool. And it does start in just over a year's time. So I guess that's the downside of this one. We've got to wait. There you go. Alrighty. Riz, I might hand over to you for the next one. It's our first one in the small business category.
This is the famous one. Everyone's heard of this. If you haven't, then welcome. Essentially what they brought in was the temporary full expensing of any assets that's purchased as a small business. Now, if you've bought anything in terms of an asset, I think the threshold was $5 billion in turnover. Which is it's massive. So it will cover quite a lot of the small businesses that we work with, if not all. Essentially, it was supposed to finish in 2022. They've extended that for another year to 2023. Now, it does mean that if you buy new assets, I think it was the 6th of October. After the 6th of October, if you bought the asset, then you'll be able to write off the full cost of that asset on your tax return. Now, in terms of secondhand assets, it's still at 150K through to 30th of June at the end of this financial year. What's cool about this is a lot of people are investing more money into equipment and cars and things like that. So that's kind of sprucing up the economy, and they're seeing that that's working really well. So they're extending that for another year. However, just want to kind of say that doesn't mean that if you want to save tax in this financial year, you have to purchase the car ready for delivery before 30th of June to claim for that. So in a month and a half time. So the car yachts are pretty busy. Your asset finance guy is probably run off his feet. So if you're thinking of doing that, make sure you get in touch with them as soon as possible. If not, you still have next financial year and the financial year after that to do that as well. Bear in mind, there's a bit of an asterisk here. If you do buy a car, this temporary full expensing doesn't have a limit if it's a business asset like a printer, equipment, or big machinery, or even commercial vans and vehicles. But if you buy a car like a sedan, there is a car limit depreciation, which limits the depreciation to $59,136. So you want to make
I've got to look that up every time, but thank you, Riz.
Yeah, I get dyslexic sometimes. I say, is it 316 or 136? But yeah, so you want to make sure that you do take that into account when you do tax planning, because don't go out and buy a Lamborghini and think you can write that off, that 200 grand Lamborghini off. There will be a limit on that, and it's probably because of that. we're not buying cars, just not producing income in the business.
That's it. Fantastic. Thank you, Riz. Alrighty. The second business one is an extension of what one of the stimulus measures actually mentioned about a year ago, which is the company loss carryback. So just as a reminder for what this one is if you use a company structure and you've been profitable, which I hope many of you who run companies run as a company, then you pay tax in the company. But let's say COVID hit, and then all of a sudden you made a loss, which is unfortunate. But one of the allowances last year was that you're able to take that loss that you made now and apply it on previous financial years. So we normally couldn't do that. The rule is you can carry a loss forward, but you can't carry a loss back. But a year ago, they said you can carry a loss back now. Fantastic, and you can go and get some of that tax that you paid in previous years back in your pocket. So what they've announced in the budget is that is now extended another financial year. So you can offset losses in 2021 financial year, 22, 23, and you can write them back against profits as early as the 2019 financial year. The other interesting thing is Riz just mentioned the full expensing of assets. So let's say you made 200 grand in profit, but you want to buy a massive truck because you're investing in the growth of your business, and that truck's $500,000. So and a brand new one. So you can write off the $500,000 truck. So you've made a tax loss of $300,000. Under the company loss carryback rule, you can actually take that 300 grand loss and write that back against your previous profits. So you see how the kind of two can work hand in hand. So it's pretty interesting there. And even that truck, you might be able to finance, so you don't have that $500,000 cash flow outlay up front. So anyway, just food for thought, and interesting how these might work together. Cool.
And that's really cool. Just a slice of a strategy that we use is things like that. So it's not about knowing just the rules, it's how you use them in tandem that really makes the big impact. That's awesome, Ben.
Absolutely. Alrighty, Riz, we're actually changing gears. So that's actually it for small business. And this wasn't like a earth-changing budget, or as impactful as the stimulus measures were last year. Quite a lot of these are extensions or small changes here and there that, on an economy level, actually have a significant impact, and even in your family might also. But they're not like bringing in hugely new or unexpected things, which is kind of good. I think we've had enough of that in the last 12 months. So that's it for small business. I'm going to hand over to Riz to run through our first superannuation change.
Thank you. Yeah, so this is relevant for those of you who have an SMSF or even a super fund, really. It's all about the contributions. Now, a bit of context. When it comes to contributions, there's an age limit in which you can contribute your super into. Now, the budget updated this one rule where it was called a work test. Now, if you're 67 years old, you couldn't contribute into super if you're not working a certain amount of hours in a week or even in a month. Now, they're going to scrap that rule. Essentially, it doesn't matter whether you worked or not, you will be able to make that contribution. So they're going to really remove that. So what that releases is this ability for you to put in more contribution into the super fund. Now, obviously, this only applies to the non-concessional after-tax contributions and salary sacrifice contributions itself. So what that means is, if you're 67 and you have to go back and prove that you work to make further contributions into your super fund, you don't have to do that. This is from 1st of July 2022, kind of similar with the childcare one. You have to wait a little bit for this, but I would start planning that essentially, because if you're thinking, oh my gosh, I better put as much as I can to super before I turn 67, July 2022, that opens up. Well, assuming it doesn't change by then, it will open up, and it means that you can contribute more into super. And the reason for this is also to kind of battle the cost of aged care and also age pension that the government kind of bears. They're trying to give more and more incentive for people to put money into their own super funds to get a tax benefit. That's the big thing here. It's essentially the tax benefit that you get when you contribute to super as a tax deduction. Amazing rule, and we have a few clients that are this is going to be super helpful and applicable for when you're transferring. Sorry?
Super helpful, pardon the pun.
Ben, good one.
Sorry,
oh
Riz.
my gosh, the accountant jokes, I can't believe we have them. So yeah, and it will be really relevant for them, and what's amazing is you're able to shift more of your wealth from outside of super into super in a very, very tax effective manner in a longer time. You have a longer lead time now, which is amazing.
Yep. And just for the investors out there, if you think of your overall family wealth, there's probably a good portion that you might have inside super, and then a portion you might have outside super. Your outside of super investment income might be taxed at your individual rates, or even if you've got a bucket company at a rate of, let's say, 30%. But inside super, the tax rates are 15% as you're growing your balance, or your balance is in accumulation mode. Or what's really cool is once you hit pension mode and you're drawing down on your superannuation, you actually pay 0% tax on what that superannuation earns. So that's, I guess, building on what Riz said about the tax incentives to put more into super. That's the huge draw card with things like getting more into super through this removal of the work test. And just to add, for the technical people out there is a limit on how much of your super can be taxed, or the income that's taxed at 0%. That limits 1.6 million going to $1.7 million of your balance. So yeah, if you've got 1.7 in super, let's say, and you can treat, probably, depending on your setup, but probably all of the income on that tax-free, which is fantastic per person, by the way. So you've got a spouse, then you've got well over $3 million of assets getting taxed at nothing.
Very cool. Yeah, and this is what's cool. Like, when you read the rules that are being announced, it's strategies like that that makes it really valuable. Knowing this itself is cool. But yeah, how do we use it to the best of our advantage? Thank you, Ben. That was awesome.
Cool. All righty. Now we do have another. Oh, I'm next. Oh, I just felt like.
Yeah.
Okay. Cool. All right. I should talk less. All right. We've got the downsizer contribution. So, what the context of the downsizer? And I did a little graphic here. We've got a big house. We've sold the big house, and then we're transferring it into the little house. So let's say you've got. Parents who've the kids have left the nest. They don't need the 5-bedroom house anymore. They want to go down to maybe a 2 or 3 bedroom house or apartment, and in the process of selling the big one, that let's say the price is $2 million for that, and then they buy an apartment for $1 million. Sorry, 1.5 mil. The difference is $500,000. So the idea of the downsizer contribution is now that couple has $500,000 of cash sitting there. What are they going to do with it? So this is a way where the downsizer contribution says now you can have 300 grand per person, so 600 grand for a couple, that you can pop into super, and it doesn't count towards any other contribution cap. The other interesting thing they've changed is you used to only be able to do this when you're 65 or older. They've dropped the age limit to if you downsize from the age 60 or older. So that's pretty cool. So it doesn't count towards any of the other caps. You must have held your big house for 10 years or more, and you also must forward the payment, so that net payment, within 90 days of settlement of the big house. So that is all about the downsizer contribution. Remember, this one applies from 1 July 2022. So don't go and sell your property right now if you want to use this one.
And again, just to add that bit, doesn't count towards other caps. It's underselling a little bit with that sentence. That's massive, because you're moving one of your biggest assets or wealth portions into super without affecting your other caps, which is your non-concessional and your concessional contribution caps, which means you still can move more of your wealth into super as well as you reach retirement age. So again, they're wanting you to use more of your own funds to support your retirement, and they're using the tax tools that they have to ensure that you don't get burdened by that when you do transition to retirement. It's amazing outcome here.
Awesome. And just keeping an eye on the Q&A box, and I encourage you, if you do have questions, just to use that Q&A box. We've got one good questions from Anonymous. For the downsizer, can a couple sell their 10-year plus home into their SMSF? The answer to that is I wish we could, but you can only transfer assets that you own outside of super into an SMSF if they're market listed shares or commercial real property. So unfortunately, we cannot sell a residential property into your SMSF. So that's that one there. Also, another anonymous, maybe the same anonymous, has asked, does the loss carryback apply? So that was a few slides ago. Sorry to change gears, but does the loss carryback apply to small businesses, structures as a sole trader or partnership? Or I'm going to add trusts there. The answer to that is also no. I feel like a bit of a spoil sport with both those questions, but the loss carryback only applies to businesses structured as a company. So it has to be a company, and you've got to make profit in the previous years to be able to go and claim it anyway. So that's the answer there.
And the mechanics for that is really quite simple, because what they're doing is when you do apply that loss carryback, you get an offset of tax in the current year. That offset comes from prior year tax that's been paid by that company, or what we call franking credits. And sole trader and all that don't have that mechanic to do that. So that's why it's only applied to companies.
Cool. Yep. Awesome. We've got a question here from Alexis, and Alexis has asked, do both parties have to be 60 plus? I might, if I was going to answer that on record, I might have to go and just triple check, but I would imagine that it's tested per person. So if you've got a spouse over and a spouse under 60, then my answer I'd be comfortable sharing is probably only 300 grand, because that's the only person who's met that test. Alrighty, downsizer super contribution tax. So Amy's asked, is the downsizer super contribution tax deductible? The answer to that one is no, unfortunately not. Not a tax deduction, and it goes in as a after-tax kind of contribution. Cool. All right. So the next one, it's also about superannuation. Riz, you actually...
I'm distracted by Steve's comment. Yes. Sorry. Yep. Keep going. Yes, I'm next.
All right. Now, not quite a budget thingy, if you call it a thingy, but it is super related. So, would you like to share us through this one you thought we should add in?
Yeah, so this was announced maybe a month or so ago, so before the budget. And essentially, there's some exciting news about super contribution limits. Prior to 1st of July 2021, or this financial year we're in, you can contribute $25,000 maximum concessional contribution, which is tax deductible, it's pre-tax money, into super fund. Now, from 1st of July, that's going to be increased to $27,500. And that's per person. So yeah, you can shift an extra $2,500, which is pretty awesome. And then your non-concessional contribution, which is after tax, goes from 100 to 110,000 from 1st of July as well. So it's in line with what I kind of see with where super funds are going. They're trying to encourage people to put more money into their super fund, put more money for their retirement, and they're doing things to make sure you get a tax break, and also you're not your caps are then increased so that you can do it sooner or quicker, so that you're not limited per year, which is really, really exciting to see, considering that we have another $2,500 in cash that we can put into super fund and save quite a bit of tax on that as well. Really, really cool.
Fantastic. And yeah, that's just the contribution limits being indexed. They, as far back as I can remember, they always have been indexed. And I think, like, let's say the 27.5 grand one was 25K. It gets indexed each year, and then it only tips over once it hits that 2.5 grand limit. So the next increase, if nothing else changes, we should see from 27.5K to 30, but that might take a few financial years to get to. Cool.
We have a question here from Howard, just because I don't want to keep moving too far past the carry back losses rules. Question is interesting. Different tax calcs with losses carry back. Would accounts have to be restated? My understanding is no, you don't have to amend your prior returns or change your accounts at all. What would happen is we haven't seen it, obviously, but there will be in the 2021 tax form a section where you can apply those credits back. I imagine it would be somewhere in the rec item, or even in the this was an accounting question, isn't it? But even using those franking credit balances and shifting some of that into this financial year.
Yeah, perfect. Yep. And even in the financial statements, I think we can adjust for that pretty clearly. So, yep. So no, you don't have to go and amend your prior year, which is good. Wonderful. Alrighty. So yeah, we were at the super limits, and then that is actually all the context. And at the end of the day, when the budget was released and we kind of debriefed as a team, we thought that this actually wasn't going to be a full-on super long webinar with filled to the brim with 20 different things we wanted to share. We've kind of picked the main, I think it's probably 8 or 9 here that we wanted to share with you. And that is it for our budget content. I do want to ask if there is any more questions to pop them in the Q&A box. It'd be great also if we could grab your name if you type a question in. There's a couple of anonymouses there, which is interesting. But the one here is, there is a question here as well. Does the downsizer contribution count towards the 1.7 transfer balance cap? So it sounds like someone's pretty clued on there into the superannuation rules. But yes, the contribution itself doesn't, but if it turns into a pension, then it does count towards that limit. So there you go. Cool. So as a reminder, pop in some more questions for the Q&A. And I might just remind everyone that we do have a webinar coming up in the next Friday, all around the topic of acquiring a business. I can see that a few people, even in this webinar, have already registered. Thank you, Steve. You're our number one fan, maybe our only fan, but we've got acquiring a business, and we'll cover through the legal side of things, but I'll also be sharing stuff on due diligence, how to interpret a profit and loss statement, and maybe if you were to consider selling a business, what you'd need to put together for that. So yeah, that's going to be quite an interesting one, a topic that we haven't really gone into on a webinar before, so I'm quite looking forward to that.
Felicity has a question. Yes, there is a bit of an update on that. So just context there. If you earn, as an employee, if you earn less than $450 a month, your employers are not obligated to pay super on your salary of $450, less than $450 a month. Now, and now what they're saying is, I can't remember if it's going to start in 1st of July 2022, but they're looking at changing that to make sure that they're eligible to receive super on those wages. So there's no kind of minimum you have to earn before you earn super. So that is a bit of again, they're trying to get people to put more money for your retirement, it looks like. And yeah, it is a little bit of an extra cost for businesses there. But yeah, I haven't seen a kind of start date for that just yet.
And I think that's going to affect the small businesses. You are right, Felicity. That is a businessy related one. That's going to affect the businesses with not necessarily full-time team members, but it might be the people with casual team. It might be hospitality or cinema or who knows. But there's that sort of workforce that's lower hours per week, might only work a couple of hours a month. That might affect there. But I actually don't think it's going to affect too many of our clients, especially in professional services or trades. So yeah.
And a notable mention, while you keep putting in your Q&A, guys, but just one more notable mention of something in the budget that I saw was to do with single parents. Now this is not tax related, but it's more to do with funding for a home. The government, and it's starting on 1st of July 2021, they're saying that there will be $10,000 $10,000 guarantees will be made over the next 4 years for parents who are single parents with dependents to either build a new home or purchase an existing home with a deposit as little as 2%. So the government's going to put 18% and guarantee that to the banks. So if you're a single parent and looking to buy or buy an existing home or build a new home, there's going to be 10,000 spots that they're going to put out for you to put 2% down. So if you do the math on that, that's 20 grand if you wanted to do $1 million property, which is pretty pretty damn awesome. Sorry, and yeah, that's right, with that stamp. So you're looking at. I don't know if there's going to be limits on the $1 million part and stuff like that, but that's going to be in the fine print, I'm sure. But that's super exciting news. I'm really excited to see that supporting single parents. It is going to be a life-changing amount for those 10,000 people.
Yep, you'd be able to get into housing given what's happening with the prices, which is interesting. Alrighty. Okay, so we got Leandri's asked losses against previous years for small businesses, only for companies. Yeah, yep, that definitely is. So you can't use the loss carryback for partnerships. I think we might not have said partnership, but yeah, partnership, sole trader, trusts, they're three structures you cannot use that loss carryback for. So that's that one there. Oh, we got a few questions popping up. Felicity, yep, so that superannuation increasing to 12%. I think in the stimulus measures that was sort of put on hold a year ago from the original plan. Haven't seen that sort of being brought forward, which is great. So still a little while off. Why does the building industry get so many breaks? They're full tilt as it is. They are, Howard. It's pretty nuts if you are into building. I've even heard in the pool and spa industry, there's a lot of people who are booked the full year ahead, which is great if you are in those industries. I think because that segment of the workforce represents a huge part for Australia, I think that's why they're trying to work out how do we stimulate the economy, and that's one easy way we can get a huge portion of Australia. So that might be why, and agreed, it might be maybe too much given the negative side effects we're getting with resources to actually build increase in price a lot, house prices skyrocket and things like that. So very interesting. Hey Riz, I might get you to either answer or research that one from Joseph around.
And Joseph, this is me guessing here a little bit, just because there's not much details just out on there. But in the past, we've seen that they do it in rounds rather than releasing all of it at once. And what we might see is exactly that, is some sort of rounds where they release some of that and see what the take up is. I'm not sure of the 100% details yet, and that's something we can definitely circle back to. And for Amy, as long as it's a company, yes, you're one of the eligible entities. So it's not really to do whether your personal, that's a separate rule, whether your personal services or not. It comes down whether you're a company trading as a company.
Wonderful. There you go. Alrighty, well, that's all the Q&A that's come through so far. I might just do a reminder as well, if you do want to talk further about this stuff or have some questions for one of our accounting team, then feel free to book a strategy call with one of our accountants. But apart from that, we're going to probably hang around for 2 or 3 minutes. And if there's no other questions, we'll finish up after that. But I just want to thank you. We kept it nice and sort of quick and sharp. Thanks for spending your late lunch with us. And looking forward to seeing you at the next webinar.